We are focusing on limited pay and single premium whole life policies for the national portion of your life insurance exam. When you encounter limited pay whole life on your test, you must remember that the policy is a form of permanent coverage that stays in effect until age 100, but the premium payment period is compressed into a shorter duration, such as 10 or 20 years, or until the insured reaches age 65. A common exam trap involves the assumption that insurance protection ends when the premium payments cease, but that is incorrect because the policy remains in force for the life of the insured. Because you are paying the total cost of the policy over a shorter window compared to a straight life policy, the individual premium payments will be significantly higher per installment. The advantage for the policyholder is that the cash value accumulates much faster in a limited pay policy, because more capital is being front-loaded into the contract earlier on. Single premium whole life takes this concept to the furthest extreme, where the entire policy is funded with one single lump sum payment at the very beginning. This creates immediate cash value, but it almost always triggers the Modified Endowment Contract, or MEC rules. The Internal Revenue Service uses the 7-pay test to determine if a policy is being used as a tax-sheltered investment rather than for insurance. If the total amount paid into the policy during the first 7 years exceeds the amount needed to have the policy fully paid up in 7 years, it becomes a MEC. Once a policy is classified as a MEC, any withdrawals or loans are taxed on a last-in, first-out basis, meaning the gain comes out first and is subject to regular income tax plus a 10% penalty if the owner is under age 59 and a half. On your exam, look for questions asking which policy would reach its maturity or endowment date the fastest. The answer is still age 100, regardless of how fast you pay it, because the endowment age is a fixed characteristic of whole life insurance. A great way to remember the relationship between payment speed and premium cost is the phrase, shorter pay equals higher stay. This means the shorter the payment period, the higher the individual premium must be to reach that permanent status. If a question asks about a life paid up at 65 policy, remember that if the insured is currently 40, they only have 25 years to pay it off, so the premiums will be higher than a straight life policy, but lower than a 10-pay policy. You should also be prepared for questions comparing these to term insurance. Unlike term insurance, which has no cash value and ends at a specific date, limited pay whole life builds equity and remains in force until age 100, even after the last payment is made. The exam will often test your knowledge of the tax implications of the MEC status by asking about the last-in, first-out method. Remember that standard whole life allows for first-in, first-out treatment, where you take your cost basis out first, tax-free. But a MEC flips that rule on its head to discourage using the policy as a short-term bank account. If you see a question about a single premium policy, assume it is a MEC, unless the question explicitly states otherwise. The cash value will eventually equal the face amount at age 100, which is the definition of a policy maturing or endowing. Whether you pay for 1 year or 20 years, the endowment age remains the same. Since these policies generate cash value faster, they are often tested in the context of policy loans and non-forfeiture options because the available values appear much earlier in the policy timeline than a traditional continuous premium policy. Always identify the specific payment term mentioned in the question to determine the relative cost of the premium.